You're watching Notepad and I'm your host Ibrahim Sani. Earlier this week we saw the highest trading volume ever done at Bursa. So it's about time that we get somebody of equities here to join us in the show to actually make sense of what's happening right now in the local bourse as well as around the region. Joining me is Andrew San, the head of equities of Amundi Malaysia. Andrew, we've known each other for quite a bit, but this is the first time I've spoken to you in years, I suppose. I want to ask you, and I still remember the last time you came on Astro AWANI was right after the elections. That was a fun bit there. Yeah, right off the bat, let's understand a little bit better about what's happening right now in Bursa Malaysia. What's going on, at least among the institutional investors, because they tend to do the bigger volumes there.
Not as much anymore, but
oh, really? Wow. So the retail
compared
guys
to the retail guys,
guys are not jumping in.
Yeah.
Let's make sense of that.
But first of all, thank you for having me on the show, Ibrahim. Good to be back again. So if you think back over the past 3 or 4 months, what has happened is that post a major sell down towards the end of March, we've had the MCO, which as a result has forced a lot of people to work from their home. And that's where we saw the rise in the number of CDS accounts that were created among the retail population. At the same time, we saw rate cuts, interest rate cuts, where you see the fixed deposit rates go down to 2.5%. And if you think about the interest income that you're getting, which is half of what you're receiving a year ago, then as a retail investor, where else do you have to put your money into? You know, and at the same time, with the low moratorium starting from April, people have had maybe about 30-40% more in terms of their income in savings. So where do they have that money, and where could they put that money into?
All right, so they plonk it in.
They plonk it in.
Okay.
But within the market, what we've seen was essentially a two-speed market. On the one hand, you've got your COVID-proof industries, or in fact, your COVID beneficiary industries, which is essentially your tech and glove names, given that we have such a narrow market in Bursa. And on the other hand, you have essentially the 90+% of names in Bursa, which are across industries, and they're impacted to varying degrees negatively by the pandemic.
Right. There's some data I want to share with you. The FBM KLCI registered the biggest single day drop in 7 weeks. The FBM ACE index surged 7.5%, and trading activities remain robust on the local bourse, with the volume swelling to a record high of 13 billion shares done. That two-speed market that you speak of, are they aware that they are entering a very dangerous area right now in terms of high risk, probably high return, but there's also high loss?
Well, there's the other factor that I didn't mention is the fact that there is no other alternative to get proper returns. You know, where else can you get potentially 2 or 3% increase in your overall wealth and your overall savings within a day? You know, especially if your target is just to beat the FD. Yeah, but in terms of what we see, especially for gloves, in terms of what you're inferring, you know, the short-term news flows is skewed towards the positive side. You know, in many ways, when I look at gloves, I think of the saying, "A bird in hand is better than two in the bush," and that bird in hand is the fact that you have increasing ASPs, average selling prices, for these glove players, and in the next 2 or 3 months, we expect further increases in the selling price. Yeah, of course, in a post-pandemic world, you will probably see a normalization in the selling prices. But the question is, when will that normalization come? How much more ASP increases will we have? We don't know. So in terms of the visibility that we have, for not just the glove players, but for a lot of the industries, it's very much blurred. But from what we know for the glove players alone, you know, when we look at the next 2 or 3 months, it's still positive.
All right, let's
And
look at the corporate earnings for the year. Quarter 2 will bear the full brunt of the hit of the MCO. A lot of the industries are affected, except for some, including glove players, including maybe utility players. Tenaga got a big money income from June that got them, I guess, in trouble in a bit with the Energy Commission. But that's beside the point. The point is there's only a few companies that is going to earn from that second quarter.
Yeah.
The rest, the majority,
That's
is
why.
all
That's
gone.
why you're seeing. That's why you're seeing the glove and tech players doing so well in this kind of environment. Yeah.
Aviation is also in trouble. We've seen CGS-CIMB put a target price of 0 for AirAsia X. Not trying to single them out, but generally speaking, aviation is a big problem moving forward. Do you think that there's going to be consolidation, there's going to be talks of even winding up?
To be honest, we don't know. But the thing is, if you look at the AirAsia or AAGB, AirAsia, the mother, in terms of the share price, and the share price is actually a good gauge of its future, of its fortunes. Yeah, we saw in June that there was a positive sentiment with that stock, mainly because of recovery. But now, as we see more cases rising and the potential of a second wave, not just in Malaysia but elsewhere in Asia, then the question is it likely to survive? If not, what will happen? We don't know. We don't know.
Because of the speculative nature of the markets right now, in fact, markets are by definition is like that, right? I want to learn a little bit more about the kind of risks and opportunities that retail investors are jumping in right now. We spoken a little bit about the glove sector, but eventually it has to, taper down, right? Are we looking at a bubble?
That's why I go back to the bird in a bird in hand is better than two in the bush. We don't know how long this super cycle of profits will last for the gloves. The thing is, the longer the pandemic lasts, the more use of gloves there will be, not just in the healthcare industry, but within the general public as well. Yeah. If you go to barbers now, you see the barbers, using gloves. If you go to the food restaurants, food industry, you see waiters and waitresses using more gloves. So that means the longer this pandemic lasts, the more popular glove usage will be, and that provides a higher base of demand for these gloves moving forward. So that means that in terms of the ASPs coming off, they may not come off as much as what many people would predict. Yeah. But the reality is this: we don't know how long this pandemic will last, with or without a vaccine, which we don't know its efficacy. Which we don't know whether it's the silver bullet or not.
It's not a silver bullet. In fact, we did a straw poll here in AWANI whether or not individuals are willing to be the guinea pigs to take on the vaccine. Not many want. They just want the FDA approved
You're compressing
product.
decades of vaccine developments into a space of 12 to 18 months. And the reason why a lot of news outlets, especially in the West, in the US, in Europe, the reason why they're pushing on vaccines because that's probably their only hope. Especially when you have elections in November in the US and maybe a few in Europe as well later this year. You need some kind of panacea to help calm people's nerves.
But why? Can you explain why the pharmaceutical players here in Malaysia are not seeing that kind of rally the same way the gloves
well, we have about a few weeks ago, but the reality is the developments for these vaccines is done outside of Malaysia, most of it, even in Indonesia, some in India, Thailand, but from what I understand, we're more just generic producers of therapeutical drugs, and more so we have distribution capabilities. But in terms of coming up with new vaccines. So far, I haven't seen any developments on the local front.
Very recently, we had Markma on, the Manufacturers Glove Rubber Association, I'm butchering it, of Malaysia. And their concern is actually two-pronged. Number one, the production lines are unable to cater for the manufacture of other types of gloves, the types that you are alluding to, including food and beverage, janitorial works, and those kind of food gloves, because the production lines is still producing medical grade gloves. That's the first worry, that they can't, attain to the demand of other use of gloves in other sectors. The second, of course, is the raw material itself. It's not easy getting rubber latex in Malaysia, since 95% of latex is imported from Thailand. And Thailand can only produce so much latex because, after all, they are one of the biggest latex exporter around the world. So even for glove manufacturers, they can't meet that kind of demand. And there's no point building more factories if you can't get the raw materials up and running. So what does this mean for the upstream and downstream of glove manufacturers, including plantation for that matter?
So actually, when you look at the breakdown of glove types, in terms of supply constraints, it's actually more the nitrile side that's being constrained right now. And the reason is the suppliers, they're concentrated. You have one or two main players on the upstream side. And the thing is, they were building up capacity on low teens demand based on their forecast. So as a result, they didn't have any spare capacity to cater for the extra demand that they're seeing now. Yeah. So when it comes to the nitrile side, yes, there is a raw material constraints, which in many ways plays to the current incumbents that we have here in Malaysia, because if you are a new player and you want to, start a line or two, right? You can't even get the raw materials to start producing. Yeah. That's hence why we see this ASP increase, this squeeze in terms of the demand that's out there, and hence for the foreseeable future, I think at least for the next 6 to 8 months, until the middle of next year, we'll see that there is this kind of supply constraint, which will further support ASP prices still.
What about other players inside the plantation industry? The Minister of Plantation Industries and Commodities have ran a very interesting campaign saying that sawit anugerah Tuhan, and this is how he's going to woo the European players out there. But that's also a big indicator that we are trying to appease to the global standards of CPO.
I think you might have so if you look at the glove industry traditionally, latex gloves have usually gone to the developing markets because it's cheaper, whereas for the Malaysian main glove players, they usually cater to the developed countries, your Japans, US's, and your Europes, which use nitrile. To switch from latex to nitrile for the end customers took quite some time for them to take up that kind of demand. And for them to switch back will present another challenge going forward as well. So it's not just about the production side of things, where in reality it's relatively easy to change between latex and nitrile and back again, but it's actually more about customer preferences and whether they're able to adjust to going back to latex.
Yeah, but palm oil, I'm talking about palm oil.
When it comes, again, if you apply that to that principle to palm oil, then again, you're asking the end clients to try something new that's not even latex or nitrile, it's something entirely new. And chances are the reason why people have switched from latex to nitrile is because of the protein allergies.
Okay.
i.e. it's organic. Yeah. So I'm not totally familiar with palm oil, but if it's organic, then you might have the same kind of issues as well.
All right. We'll take a short break before we continue our conversation with Amundi Malaysia. Don't go anywhere. Thanks for staying on with us. If you are aware, the equities of the country is actually doing quite a robust traction in terms of getting retail investors as well as institutional investors in. But of course, there's a lot of sell side happening this week. And joining us is Andrew San, the head of equities of Amundi Malaysia. Andrew, let's talk a little bit about some risks that is on the horizon. There is a government risk in a way. There are talks that there will be elections in the offing. How does this factor into the investor trying to make sense of what's happening in the market right now?
So whenever you have political risk, introduces uncertainty, and that translates into market volatility. Yeah, where it translates traditionally into the market is in certain sectors that are more sensitive to politics. Yeah, it's always been about construction, and with PH changing a few of the regulatory frameworks of different industries previously, now you're introducing some political risk into the likes of telcos and utilities as well, in particular. Yeah, so where these types of industries are concerned, you might see some clear avoidance by various investors in these sectors because, you know, we don't know what type of policies will be put up and by which governments going forward as well. Yeah, so that again narrows down your opportunity set into what you can invest in the other sectors.
It's like a push-pull factor right now.
Exactly.
Describing.
Exactly. Again, it's TINA. There is no alternative.
The Sabah election is on the cards as well. They have to hold an election within 60 days. Does that have any factor into how we view the market?
I think it presents a more near-term. It actually brings forward this specter of political uncertainty. I think if you talk about political uncertainty, even when they had the first parliamentary session a few weeks ago, I think the market hasn't been pricing that in as much. But with what's going on with Sabah and what happened with the Najib case, I think it's bringing that uncertainty, the political uncertainty, more into the forefront of investors now.
I don't know how familiar you are with derivatives, but some investors want a little bit more stability and they are looking at derivatives. Do you have any comment on that?
One thing that we've looked into is the activity among warrants. Yeah, especially when it comes to gloves. Yeah,
we can't escape this glove conversation.
Exactly. Well, that's to be honest, that is the only thing that's moving markets right now.
Yeah.
If you took out gloves from the glove components from the index, I think the market would be down 10% for the year. Yeah, it roughly in line with the regional markets. But instead, where are we now?
Yeah,
roughly back to where we started at the start of the year.
It's more of 2019, I suppose. If we take out the glove sector, the way everybody was trying to make their gains, but we are not in that sense. But anyway, back to warrants. Yes.
So for warrants, it's a way of it's a way of boosting your gains rather than for stability reasons. The fact of the matter is, from what I see, derivatives is still a very niche part of the index, niche part of the Malaysian market. We're still going into our traditional asset classes, whether it's fixed income for the institutionals, equity, or fixed deposits. That's basically it. But yeah, we don't see derivatives as a way of hedging. Because we have to see how it performs during lower volatility conditions as well.
Okay. Yeah. Then you can benchmark and take the average.
Then you can actually say, okay, that's part of an asset class that you're willing to go to.
Okay.
it doesn't make sense that derivatives dry out and it no longer becomes a viable option for you going forward.
And of course, the traditional big players out there has always been the banks. The banks are in a very, very tough situation right now in the sense of their earnings for this year. But no love lost amongst the people of Malaysia when they think about banks, because they are still registering billions of ringgit in terms of income from interest income, as well as other fee income of banks. But this year is going to be very different for them. What's your outlook there?
It's different in the sense that market expectations have changed. They have changed since when loan moratorium was first imposed. So you talk about the August month being a tough month because of the earnings season. I would say that in a lot of cases, including with the case of banks, results shown during the month of August will be shrugged off, for lack of word, because firstly, we don't know the level of NPLs that or the real asset quality that they're experiencing, because no one is paying down their loans yet. So when no one's paying down the loans yet, we don't know the experience of collections by these banks, and we'll only know by the fourth quarter. And
assuming the moratorium is not extended.
Well, from what the PM has mentioned, yeah, by and large, it's going to end by end of September anyway. So we'll assume that that's the case.
For some of us, for many of us, it's still targeted moratorium.
Well,
those that have not had a job, those do have jobs but do not have or enjoy cash flow, that kind
lower
of
incomes.
Lower incomes.
Yeah. So, but I think by and large, people will start paying off their loans. That's our base assumption. Yeah, if you look at official unemployment numbers, yes, it's gone up to 5%. Underemployment, which is where you're talking about people are getting paid less for less work or less working hours, then it might be higher than that. But by and large, most people will still be out of that loan moratorium period and be paying down their loans. So based on that, we will be able to get a better gauge on how people are being how well people are being able to pay down the loans, and from there, we'll be able to know what the level of NPLs are. But for the time being, the market is quite sympathetic to a lot of companies, not just for banks, but for a lot of other companies, because of the disruption that MCO has caused in the second quarter, and perhaps less so in the third quarter. Yeah, and just like many other major markets, a lot of the market participants are moving towards a 2021 outlook, yeah, because they know that this year is largely a washout already. And that's why you're seeing, let's say in the US, you're seeing a bit of sentiment that's turning negative now, because the notion of a V-shaped recovery may not longer hold true. Yeah, and that will definitely feed into the sentiment here going forward as well.
It's interesting for companies to think about 2021 right now, because the WHO doesn't believe that it's going away. This is the normal. It's not even new anymore. It's been around for quite a few months already. What's it like, going into the equities right now?
It's nuts.
It's nuts, right?
It's nuts because there's a big dislocation.
Companies are being listed right now. It's bizarre. I mean, we are in
rightly
Bursa
so,
Malaysia.
because the sentiment is so strong, and then you might as well take
IPOs are
advantage
happening
of
every
that.
month.
But the reality is there's a big dislocation between what the market is going through right now and what the underlying economy is experiencing. Yeah, and a lot of that would have to go down to what central banks have been doing. Reducing rates, increasing money supply, and when you have less places to put your money to get a decent return, the only thing that you can do is just go into the riskier assets, i.e. equities, to get your returns. And that's exactly what we've seen, not just in Malaysia, but elsewhere in other parts of the world. So what do we see in 2021? I think that a lot of it would have to depend on geopolitical risk that's going to run up until November with the U.S. elections. And beyond that, with the economy, it also has to depend on how well we recover, and that's where banks in the fourth quarter have a key play to part in terms of us analyzing what collection rates there are within the economy. But going forward, yeah, it's going to be tough. And as to which presidents the U.S. will be having, will actually dictate a lot on how China and its relationship with the U.S. will be, and by extension, the rest of Asia will be affected nonetheless.
Since we're talking a little bit about geopolitics, the relationship of Malaysia and China is also quite at an awkward position right now. The stance of the current government is trying to appeal towards the better sense of China, but China is China. This geopolitical sense must have some impact towards how investors view the markets.
Well, so far we haven't seen anything that's that forces investors to take note yet, But if we do see some physical tussles that would impact us in terms of sentiment locally, then yeah, then we would see this as more of a black swan type event, yeah. But for us, we are a trading nation, yeah. So that's why I talk a lot about U.S., China, and the rest of Asia, because a lot of how other countries do will impact upon us as a trading nation, as a key exporter and key importer of various goods and services.
Final question would be on ETFs. Is this a better way to hedge some of the risk that persists in the equities sector?
EPF?
Yeah, ETF.
ETF, sorry.
Yeah.
So far, not yet, because I think for the retail investors, it's not something that they've considered. It's a matter of, well, you look at the volumes. With ETFs, it's not moving in line with how KLCI is moving, mainly because there is a natural tendency towards moving to unit trusts, or if not, going directly into stocks. And in this kind of environment, why would you want to buy an ETF when it includes a lot of the industries that you don't want to be in? So ETFs maybe
by nature that's what ETFs are. You hedge your risk across various industries.
But in terms of the local behaviors and the local habits, where we've started out from a retail point of view, we started out as an industry with a lot of unit trust influence, and a lot of investors who individually invest in stocks. Then the question is, why would you want to go to ETFs when you can do things yourself? And remember, ETFs don't come for free either.
No.
Yeah. So that's why, from what I've seen, the volumes for ETFs remain low, and it's a catch-22. If ETFs are not tracking your underlying asset well, right? Then I don't have an incentive to invest in that too. Yeah. So I don't foresee ETFs to come in a big way unless there's a big regulatory and industry push towards the adoption. But then who's going to push it on the industry side? Banks still earn a lot from the unit trusts that they provide. Yeah. And obviously on the brokerage side, with investors investing directly into stocks. So if I'm going to be a passive investor and invest in ETFs, for the industry, that doesn't make much profits for them.
Right.
Yeah. So that's the reality. It's a chicken and egg situation.
Okay, fantastic. we have to draw this conversation to a close, but I hope you can come on my show again. That was my conversation with Andrew San, the head of Equities of Amundi Malaysia. If you've missed any part of this interview, just head on to astroawani.com, look for Notepad over there. There's plenty of interviews like this that can be found there. That's it from me for this episode. Until next time.